Aussie families with health insurance could be set for an increase in premiums that's at least $50 more than the federal government is predicting this year. Now, according to a new analyst from Compare Club, premiums are set to increase by an average of 2.7% in 2022, with government calculations putting the average increase to families at $125 plus. But Compare Club's analysis of its customers' average annual premium suggests that that number is closer to $154 for a family with both parents in their late 40s, and could be as much as $174 for Australians over 60. That's almost 4 times the current inflation rate of just under 1%. Joining us today to discuss the increase in premiums is Compare Club's CEO, Andrew Davis. Welcome, Andrew.
Hi, Michael. Nice to be here.
Now, the increase, it's a regular thing that happens. Is this a bigger increase than what we were expecting?
It's certainly a bigger increase than what I was expecting. It does happen every year. There's a premium increase for private health insurance fees. The reason I guess I expected it would be lower this year would be because in the COVID world, access to services that typically are used by private health insurance consumers has been so reduced that there's some money around that the health insurers have made, and therefore I expected it would have been a lower increase.
Mm-hmm. We've actually seen some of the motor vehicle insurance companies offer a rebate to some of their clients because the cars were being used less, the claims were obviously down. No such luck with the health insurance?
Well, no. So some of the health insurers have offered rebates, which impacts which is based on lower utilisation last year, and this year some of them have agreed to delay the effective date of the increase. It's normally 1 April across the board, but a number of health funds have said they'll wait till a later period. A couple have said September, and one's even said November. So yes, but it's still an increase nevertheless. And once the increase is in, it's there forever. And next year's increase will be on top of this year's increase.
Now, as a family and as a consumer, what's the best way that I can make sure that I'm getting the best deal? Because I know with myself, a lot of the times it's in the too hard basket. It's just, you know what, leave it, set it, forget it. How much harm am I doing to my hip pocket with that little bit of apathy or laziness to just leave things as they are?
Yeah, I mean, doing that over the years will do you harm of several $100s per year. And more, even more importantly than that, it might mean that you actually have a policy that might have benefits on it that you don't need, right? So, single males don't need pregnancy cover, right? People who are 70 years old don't need pregnancy cover, right? And if you're paying for stuff like that, then you're paying a lot of money for something that you won't need. Or alternatively, you might be missing out on something that you didn't need at one point in time, but you need now. So, people with small children typically wouldn't need orthodontic cover for braces, right? But if you've got teenagers, having that on you're paying a bit more for your premium, but having that on your cover will potentially give you back a couple of $1,000s, right? In benefits. So there's 2 parts to the exercise. One is really making sure that you have a fit for purpose policy for now and for the foreseeable future for the next couple of years. And then the other one is making sure that you're not overpaying for that, because there are lots of policies that are very, very, very close, very, very, very similar, and by comparing the different companies and different brands and different policies, you can save yourself quite a lot of money.
Now, do we see some consumers opting out because of the price rise? Because it is a significant cost. I'm a sole father of a 10-year-old daughter. I can't afford not to have it, but the cost of having it, it's starting to get a significant impost on my life. Yeah,
I mean, it's a very significant expense. Interestingly, over the last couple of years, I think with people so focused on their health, and also with people understanding how long the waiting periods are in the public system, there's actually been a reduction in the number of people dropping out. And the industry, even though the borders have been closed, the numbers have actually grown. So there are still people who drop out, and it is a big impost for people, and that's why people should be looking for an appropriate level of cover given their age, their health, and etc. But overall, I think people understand the alternative, and the alternative has probably become a bit less attractive because people are understanding the demands on a public system over the last couple of years, and what that would mean for them if they ever needed to access it.
So, Andrew, I come to Compare Club. I come in. How often should I be checking my policy fit for purpose and cost wise?
Yeah. So unless there's a major change, right, then every 3 years should be enough. Again, sometimes there's a natural change. So your 10-year-old, you might be taking them just to get their teeth cleaned, and all of a sudden the dentist says to you, well, in a couple of years, I think orthodontics could be on the cards, right? Which would not be unusual for them to say to a parent of a 10-year-old. Well, then you should think about making sure that you have good cover for that, right? So there can be things that change in people's lives. People can partner up, and that would be a change. People can finish having children, and that would be a change. So there's a bunch of stuff that can happen. But normally, as a rule of thumb, right, every 3 years should be adequate.
And waiting periods and things like that. I notice a lot of companies offers the no waiting period if you sign up. Is that their hook? Is that their sales pitch?
So interestingly, when you move between health insurers, right, the new health insurer is not allowed to impose new waiting periods, right? So long as you've served out the waiting period with the old policy that you've had, and the maximum period would have been 12 months. So in other words, if you've had a benefit for 12 months or more, and that benefit's available on new policy, there's no waiting periods. And the industry is regulated in that way intentionally by the government, because otherwise people would be stuck, right? And if people are stuck, you know what happens when what companies do to consumers when they don't have an alternative, right? So it's regulated. So there's actually no waiting periods when you switch. There could be a waiting period if you add something. So again, using that example of orthodontics and braces, if you don't have it now and then you add it on, then there could be a waiting period of a maximum of 12 months. Some certain waiting periods are 2 months, others are 6 months, and the maximum is 12 months. But in general, what we find with most consumers when they move policies is that they don't have waiting periods because they're already covered on the current policy for the services.
Now, given the Victorian government, especially their ban on elective surgery, does that affect a policy in any way? Is there any way to?
Yeah, so it hasn't, and I think that's what I was saying. Why it's a bit surprising that the premiums are going up because people haven't been accessing their policy in a way that they normally would have. I think that's one of the reasons a lot of the funds have delayed the date of the increase, and I think they're expecting that once that ban is removed, and it's not just in Victoria, it's already been. New South Wales has starting to remove it, and it's in Queensland as well. Once that happens, there will be a rush because people call it elective surgery, but elective is a really terrible term. These are surgeries that people need to have, and people are waiting. They're not life-threatening, but just because they're not life-threatening doesn't mean they're not important. They don't need to happen. So I think that will start getting back to normal, hopefully, over the next few months.
Yeah, I think elective surgery is probably the worst name ever applied to anything. It's actually scheduled surgery. So within that elective surgery, there's cancer diagnosis, there's restorative figures, there's surgery that allows people to return to work, return to caring, even to care for themselves and toilet themselves is all in that elective surgery. So it's the worst name of all times, apart from Victoria's award-winning vanilla slice. I see everywhere. So, Andrew,
I agree.
Top 3 things that consumers should look for. What would you recommend?
Yeah. So consumers, number one, should have a look at what they have and what they're paying and what they're being asked to be paid. So the 2.7% is an average, right? But different policies will go up by different amounts, and it won't be uncommon for a policy to go up by up to 5%, right? So they should look at what they've got, what they're paying, and what they're being asked to pay. They should look at the services that they use regularly. So, for example, their general dentist, right? And they should look at whether the gaps that they have are reasonable, and if they're not, how they can deal with that, right? And we just spending a short amount of time on doing these things, can put several $100s back in the pocket of consumers and give them a better experience.
All right, Andrew Davis from Compare Club, thanks so much for your time today.
Pleasure.